Hello, I'm Rick Schumacher with LBM Journal. I want to thank you for joining today's webinar, Operational Strategies for Increasing Valuations. In this webinar, Sam Brownell, founder and CEO of Stratus Business Advisors, and his guest, Operations Specialist Emily Overson, will break down Valuation 101, why detailed valuations matter, how buyers assess risk, and how confidence drives multiples, while focusing on one of the most powerful and often overlooked value drivers, operational efficiency. You'll learn how documented processes, clear decision rights, reduced owner dependency, and consistent execution can dramatically change your company's value story, even with the same EBITDA. They'll also cover transition options, succession planning, team structure, and actionable next steps to increase predictability, scalability, and long-term enterprise value. Sam Brownell, CVA, CFA, MBA, and I don't know what those remind me, what does those stand for, Sam?
Yeah, so the CVA is a certified valuation analyst, CFA is chartered financial analyst, and then MBA is your Master of Business Administration. So yeah, lots of letters.
Lots of letters. All right. So Sam is founder and financial advisor at Stratus Wealth Advisors. He's also the sponsor of this webinar. Sam has been a financial pro since 2006 and formed Stratus Capital Management in July 2013, which has since grown into Stratus Wealth Advisors to provide goals-based financial planning and investment management to individuals, families, and independent business owners. You can learn more about Stratus Wealth Advisors at stratuswealthadvisors.com. And you can meet Sam in person at the LBM Strategies Conference, which will be in Milwaukee this fall, October 14 through 16. Emily Overson is an operational expert. She is the founder of Emily Overson Consulting, and she specializes in working with LBM pros. And she is also typically at the LBM Strategies Conference. Okay, a couple details before we get started. All attendees are muted so you can hear us, but we can't hear you. If you're having technical issues, click the chat button at the bottom of the screen to send us a message. We'll work to address any problems in real time. If you have questions for Sam or Emily, click the Q&A button at the bottom of the screen anytime during the presentation, and they will address as many questions as possible following the presentation. And lastly, we expect the webinar to be finished in about 30 to 40 minutes. We are recording it, and we'll send a link to the recording to everyone who registered. Plus, it will be posted on lbmjournal.com. And with that, I turn it over to Sam and Emily.
Great, thanks, Rick. We're excited to be here. I'm particularly excited to have Emily here. As Rick was saying earlier, this is an area when people think valuation, lots of times they're thinking things like multiples, or they're thinking about things like what is my cash flow and how do I work at growth, financial statements, and all of that is great, but something has to underlie all of that, right? There's some part of this that is driving those financials, and that's what we're really here to talk about today. And that's why I'm really excited to have Emily here, because she's the expert in this area. And whenever you're doing any type of succession planning work, and we'll talk about this a little bit later, it's a team. Nobody has a lock on all of the expertise. It's very specific knowledge, and getting your operations in place is something that is often overlooked, but is something that is really, really critical, not just to pricing, but also to ease of transition. And so we're going to jump into all of that shortly here. But first, just a brief intro to both of us. As Rick said, my name is Sam Brownell. We're with Stratus Business Advisors. Our goal is to keep independence independent, and we are very agnostic as to how the transition happens. We want to work with you and your goals, and we also want to help you to get to the point where your business is more valuable, it's running more efficiently, and it's easier to transition. And that's exactly what we're doing here with Emily. So with that, Emily, I'll turn it over to you to introduce yourself.
All right. Hi, I'm Emily. As Rick said, I founded Emily Overson Consulting back in 2019. Prior to that, I've got about 3 decades of business, financial, operation, and management experience. The last 2 decades of which have been devoted strictly to LBM. Like Sam and Stratus, I focus on independent dealers and really helping them maximize their investment in their business, maximize their outcomes, build really a solid team. just like you're creating for all of your businesses, for your customers, solid buildings, good foundations, good structures. That's really what I come in and try to help businesses do, improve their foundation and build a solid business.
Yeah, no, I think that's exactly what we're gonna hit on today, and we'll get to some specifics, but any type of planning process has to, just like any type of operational process, has to have an outline, right? We have to know where you're going and know what you need to do to get there. And within this larger succession planning discussion are these very specific things that you need to do. And today it's operational efficiency, and it's where to invest. And Emily, I'm gonna gonna turn it over here and get your thoughts as well. But I know that a lot of folks look at things, especially in this industry, as cost centers. But if you're doing it right and you're doing the operational piece right, this is an investment, and this is an investment that's going to pay off, correct?
Absolutely. You've got to kind of look at a lot of this as, when a situation arises, is this something that we got to triage? Do we need the ER to stop the bleeding? You know, um,
Yeah,
but the key is, we can just put a Band-Aid on some things, right? And the bleeding will stop, but every time we pull the Band-Aid off, we still bleed a little, and we put a new Band-Aid on. So that works, and it's better than it was, but it's not as good as if we go in and get stitches and we really solve the problem. Now that turns that into an investment. And so now you're reaping the benefit of really having resolved that problem and not continuing to bleed out a little bit here and there.
yeah. No, I think that's spot on, and it's really a thing of putting in the time and the effort, and yes, the investment up front will pay off, and that payoff we see tends to grow over time too. It's not like I'm going to recoup my investment by 10%, right? It may grow at 10% a year for 5 or 6 years. So we're really accelerating as we're going here. But let's dive into the meat here a little bit. And one of the things that we see a lot and we talk about a lot at Stratus is there's a difference out there between, there are lots of different places, right? If you want to just get a basic idea of what your business is worth, right? There are calculators out there. You can go and get a broker's opinion of value to what your business is worth. Little bit like using a TurboTax, right? It'll give you an idea of where your taxes are. If things are very, very simple, that's great. The problem is, in this industry, things typically aren't very simple, right? We've got all kinds of moving pieces, and regardless of who is buying the business, whether it's a third party or whether it's something like an employee stock ownership plan, a perpetual purpose trust, there is somebody on the other side who is going to be doing due diligence to make sure that the asset that they're buying, right, the operations that they're buying are actually what they think they are. And this due diligence process is part of what a detailed valuation is all about, is understanding the depth that you have to go into to really understand what's going on under the hood of a business, which you can't get in a lot of these higher level calculations of value. And so, Emily, from your perspective, as you're walking in to a business that you're starting to work with, and curious, just what are some of those areas that you're looking for that tend to be the needs work?
And it's common. Some people are further ahead than others, but really it comes down to the same things with every business. Um, what do the finances look like? Even if it's a healthy finance, do they have good structure with it? Are they crossing the T's and dotting the I's? Operationally, same thing. They're getting the job done or they wouldn't be in business, but how
Right.
effective are they at it, at
Yeah,
doing it day to day? How many challenges, how many times are they putting out fires?
right.
So much of it really just comes back to having structure in their business, and defining all of that, who does what, And
Yeah.
yeah, it's the same challenges over and over. Then we've got the whole other layers of the personalities, whether it's a family-owned business or
Right. Right.
or non-family, the business structure and roles and those personality and family dynamics is a whole nother layer that's often present.
Yeah, exactly right. So we're working on many different layers, and all of this stuff ultimately is going to impact evaluation, and we'll get into some examples later. But I do think it's really important for you to know that getting into the weeds, so to speak, is how we can determine not just where there are problems, but where we can make adjustments and where we can fix things, because every business has ways that they can increase value. And that's not things that you can pick up if you're just doing a very high level look and saying, all right, what is my EBITDA and what is a multiple? Okay, everybody's selling for about 4 to 5 times. That's great, but that's not really going to tell you your specific business. How is somebody going to look at your specific business? And what are you doing under the hood? Are you a rural business? Are you multi-location? How old are the people that are working for you? Do people know what to do? Right? If Emily and I are working the business and Emily is gone for 3 weeks on vacation, do I know what her job is? Who's covering her roles and responsibilities? So all of this stuff I think is really important to think about. And valuation comes in a number of different ways in the succession planning process. It could be just, where are we? I want to benchmark this business and I want to know. That's the beginning of a financial planning. Okay, well, I know my business is worth 5 million. Well, we sit down and we do a post-ownership cash flow analysis and we find out, well, it'd be better if your business was worth 6 or 6.5. Okay, great. How are we going to get there? Right. And that's where a lot of times bringing somebody in, or we may make the recommendation to bring somebody in like Emily, right, who is going to be able to help put that business on the right track. Because one of the things that we always talk about is this idea of predictability, right? And nothing is really predictable, but if you can have an idea of what your growth is and be predictable more or less in your margins, that makes somebody feel a lot more comfortable, right, Emily? And I'm thinking about a couple conversations I've had in the last 2 weeks with owners where if if you're bouncing around on your margins, even if the last year was down and now you're up again, that's not to say that the next year you're going to be steady or up again, right? It's volatility is not a good thing. It raises more questions.
Absolutely.
So I think this is the area where it's really important to get under that hood and to understand exactly why you need that valuation. So on a larger scale, goal planning, right? Short and long-term goals, we all have them. And I think Emily and I were talking yesterday, and I'm gonna let her. I'm not gonna steal her thunder here, but I think she had a great way to think about this and really good actionable tips for folks, because it's great to have goals, but we all have them, right? It's like, every year you go to the gym in January and it's packed, and by February there's nobody at the gym, right? Because they couldn't convert, right, from short to long term. So, Emily, I'm curious, and you had shared something great a couple days ago, that I think will really resonate with folks about how to make these goals stick a little bit better.
Right. So working with another group and talking with another professional, he threw out these statistics. Only 1 in 5 people set goals to begin with. So if you are someone that's been setting goals, you're already in the top 20%. However, of that top 20% that set goals, only 1% of those 20% actually write the goal down. And there's something very different if we don't talk that goal or write it down. It's said that it's just a wish. It's not really a goal. It's just a wish. So only 1% of the 20% actually write it down. And then only 1% of those people that write them down go the next step, which is what's critical, because this is, again, what's going to help take it from just being a wish to reality. And that's writing down the 2 or 3 things, that action items or the steps that you need to take to make that goal happen. You know, I can
Yeah.
say I want to become the best lacrosse. We were talking before the webinar began about lacrosse. I can say I want to become the best lacrosse player in my community lacrosse thing. But if I don't then commit and go to training and go to practice, I'm never actually going to get there. So I can dream it, but
Right.
it's not going to happen.
Yeah, and I think that's a really important part to all of this. And so really the idea here is just find somebody that you're comfortable discussing this with, and then write down these goals, and it's financial and non-financial too. And this is where legacy becomes a big part, particularly to the owners that we talk about, right? Very few people want to be known as the person that sold to the private equity roll up and the town lost 20 good jobs and they moved out of town because they had a distribution center that was closer to the larger cities. So, these are things to think about as you're going through the process because we can solve for these goals if we know what they are. And so I think that's a really important place to start. And so now we're going to get into this to really the meat of this, and I'm going to turn it over to Emily here to take it away. But the idea is where am I going to invest? And there are lots of different areas to invest in, but this idea of operational efficiency touches everything you're seeing here on the screen and really can make that business turnkey, right? Run so that we can pull somebody out and put somebody back in, and it's going to make things a lot smoother. So with that, Emily, I'm going to turn it over to you so that you can run with this part about operational efficiency to improve the value of your business.
All right. Thanks, Sam. So, yeah, we're going to dive into the operational realities of the things that you can do and why this does impact it so greatly. Because as Sam said, while you could just get a valuation, the simple equation plugged in of my business value, my assets, cash flow, things like that, that's not really giving somebody the true picture. And where people get those high multiples are because there's real value behind it. It's kind of like in your organizations, if you're just selling off price, then what have you got compared to the dealer down the road that's just selling the exact same product? Your people have to be able to sell the value of what's coming with buying from your organization. So that's a lot what this is about is putting together those pieces that will help communicate that value. All right, next slide, Sam. So a lot of dealers that I walk into are very profitable, right? They've got strong earnings, they've got long customer relationships, they've got a solid market presence, and on paper they look healthy. But when buyers walk in, they don't necessarily see what you see. They don't see the history. They might have heard about it, but they don't see it. They can read that you've got customer loyalty, but that's not something you can see, and they can't actually see the legacy. They're going to see the risk that's potentially there in that business, right? And so what are some of those risks that we can identify? No documented processes, right? Every time we hire somebody new, we've got to reinvent the wheel because there's not just an onboarding process. Here's the steps we go through. Everybody gets the same message every time. Another problem can be owners carrying too many decisions. Everybody needs permission to do anything. It's the old hub and spoke entrepreneurial mindset
Right.
where they're the center of the universe. Sam, you witnessed that?
Oh yeah. Yeah. Yeah, no, and that can be a real killer when it comes to ease of transition. So yeah, no, I think that's a huge one, and it's a risk that you don't often see if you're the owner themselves.
Absolutely. Next one up, and if I had $1 for every time I heard this, I'd already be rivaling Warren Buffett's bank account, right? That's how we've always done it, right? But nobody can tell me why. And that's one of the things when I work with dealers, that's the first questions I start asking when I'm there is, why do you do these things? you know. And what I stress and the takeaway for everybody here today is it's not that you're going to have to reinvent everything you do, but when we've lost the why, we're just there's no passion behind it. There's no is this really serving us anymore? So I tell dealers, 70% plus of your processes will likely stand after we go through these motions, but your people will understand the why. And that's part of what shifts you from that hub and spoke, and everybody's got to come to the center of the universe to get the answer because they don't understand the why. If I understand the why, now I'm empowered to make good decisions that go along with the company's mission and value statements.
Yeah, agreed.
Good deal. And then another one is results depend on the people, not on the systems. So Sam already alluded to this earlier. What happens when someone leaves unexpectedly? Now we've got this big gap. Emily's on vacation for 3 weeks. Does Emily really get a vacation for 3 weeks is the first question. Or is she checking emails and her cell phone constantly? Or if she does, yeah, what's falling apart back there if there wasn't somebody that was second in line and really understood what needed to be done and can perform it confidently.
Yeah.
Excuse me. So, that's big hazards. If performance depends on a couple of key people and or an owner answering every hard question, that's not stability. It becomes concentrated risk.
Mm-hmm.
And hard truth, and Sam can attest to this, right? Buyers discount chaos.
Yeah.
And that's what risk is, right?
Yeah, exactly. Something that we can't mitigate to a large extent is gonna come back and bite you in the butt in evaluation.
Oh. So that shows up in those risk adjustments and lower multiples that Sam's going to get into a little bit later. All right, next slide. So again, buyers don't buy your past earnings. What they're buying is their confidence in your future. So if we walk through these and answer these in your head, can this business run without you? Or do the wheels come off the bus as soon as you're not present? Are your results predictable month to month, as Sam said, or do we have a lot of volatility in what things look like? Are decisions made consistently? And can growth happen without chaos? If the answer, go ahead, Sam.
No, I was just going to say that's a great way to put it, right? Because if we're running around chasing our own tail, even if we're growing, it doesn't look like that from the outside. So yeah, that's a great way to put it.
Yep. Somebody told me early on, and with multiple locations is an easy way for everybody to grasp, even if they don't have it. But you're just multiplying chaos the more locations you have if you haven't reined it in. And so someone told me early on in my career, you can run 2 locations and still be dealing with this some. You'll feel like your ears are bleeding when you go home at night or your hair is on fire, but you can get away with it. But once you hit 3 locations, you might as well have 30 because then it doesn't matter. The chaos just multiplies so much more because you can't be in 3 places or 30 places at once. Where 2, you can kind of bounce back and forth. But yeah, that's what honestly what I see strangulates more dealers' growth than anything is their own inability to rein in the chaos and get a handle on it. Because our customers, our community can see that we can't handle things well, so more business doesn't come to us. Whereas the dealers, once they make these shifts, I have yet to have a dealer who made the shifts, put in the work operationally, and didn't see growth start happening without any strategic initiatives, it just starts happening over the coming months and years, and continues in a positive way, even without adding more salespeople, more sales initiatives, things like that. But it's just because now they've got capacity because the chaos is gone. So if you answered mostly to those questions, the hard facts are the multiple is going to reflect that when you get into the valuation, because lower confidence is going to mean a lower multiple. Higher confidence brings those higher multiples. Excuse me. So I've been sitting there, I've been in you guys' seats. I've sat in leadership meetings where everybody's exhausted, where the owner hasn't taken a real vacation in years. And we've touched on that mindset. Yeah, they leave, but do they really leave? They're still checking emails, still on the phone, still got their finger in there every day. And too often that burnout gets disguised as commitment. And that
yeah, that's a very good point. That's a very good point. Yeah, no, I totally agree, Emily.
How many of your clients have come to you, Sam, a little too later in the process than is ideal, because by the time they come, they're just ready to be done?
Yeah. Yeah, no, I think that's a really big issue that everybody runs into, because if you get to the point where you're burned out, and I think this is a perfect time to talk about it, because that last bullet point there, but that's too late. There's not a whole lot we can do, right? If you came and said, "Hey, I'm done. I want out by the end of the year." Okay, we'll be able to help you, but it may not be what you want. And so think about, work backwards. What is the age, or what is the number of years I want to be running this business, and then work backwards at least 3 to 5 years, because then we can make some changes, and those last years are not going to feel so overwhelming, because you are going to have the ability to build a team, and to get some of these processes off your plate. And it may be more fun to be involved in the business at that point, when you're not the center of everything.
Exactly. Relieve some pressure off yourself.
Yeah, yeah, exactly. So no, it's just don't wait too long, I think is the way to do it. And it's hard, but reach out and start that conversation early, because then if you're on our radar, Emily's radar, we can always continue to follow up, and poke, and say, hey, have you thought about this? Have you thought about that? So yeah, so let's keep rolling here.
You bet. So yeah, that kind of hero culture feels noble, and that's what many of us, I see this a lot in legacy family businesses in our industry, especially, because all the prior generations worked hard, and so we've got and everybody stayed there from sun up to sundown, and nobody took vacations. So it feels noble. It feels like we're carrying on the family tradition and the legacy, but to a buyer, it feels fragile. Okay. Because in reality, when we look at things, we've got two companies. They can have the same revenue, the same EBITDA, but they're going to have very different values. And that difference comes in because of the confidence or lack of confidence in the sustainability of those businesses. One is system driven and therefore has higher confidence. One is personality driven. So those multiples are going to be different, not because the math is different, but because the risk is different. So we need to realize that predictability is what drives value, that consistency month over month. Stability drives value, and governance drives value. So
yeah. No, it's all those qualitative pieces, and where they come in here, and this is something that Emily and I have talked about a lot. But just looking at this screen here, the difference between company A and company B, there are risks that everybody shares, right? Everybody has to deal with the macroeconomy. Everybody has to deal with policies. Everybody has to deal with the fact that they're not the largest company in the world, and that we're in an industry that is more sensitive than something like healthcare. right? Where it's a little bit less sensitive to the whims of up and down. Everybody needs to go to the doctor. Everybody needs to get checked out. But it's these bottom three really that are going to drive, as Emily was saying, that multiple. This is where the risk comes in. What is that company specific risk? And this is what people are looking at. This is what knocks a 5 to a 4.5, a 4.5 to a 4.2. This is where you really have to focus, because this is what's going to be turned up in a valuation, in a detailed valuation that includes this, what I would consider pre-due diligence. But the good news is that then you can do something about it. And I think that that's the whole point of this is, yes, a lot of us are struggling with similar things, but being proactive, I think, Emily, is really the message here for everybody.
Exactly. Yeah.
So let's spend just a little bit of time, and then we can take some Q&A. So transition options up top, I talked about how it's really important to know that there's more out there than, well, my kids don't want the business, so I guess I'll just have to sell to a private equity backed roll up. And and both Emily and we do a ton of work with the independents. It's important to have these independents out there. And so knowing what is out there is really important. The other thing that we always talk to folks about is net. You're always thinking about things on net. Yes, you might be able to get a little bit of a premium if you sold to, the US LBM or Kodiak, now part of QXO, but you don't have any control over the timing. You have very little control over the tax implications. And what's good for the buyer is not good for the seller and vice versa. And if you don't have a lot of leverage in a negotiation, you may end up paying a lot of ordinary income tax where you didn't think it. And so a lot of times knowing these other options, right? Employee stock ownership plan for bigger businesses, worker owned cooperative, right? The Ward Lumber is a great example up in upstate New York, or this newer idea of a perpetual purpose trust. But all of these are stock sales and typically all long-term gains, right? Much lower tax rate. So thinking about that, I think, is important, and just reaching out and knowing who is interested. Oftentimes people will say, well, my kids or my employees aren't interested in the business. Well, did you talk to them? No, but I know they're not. Okay, well, it's better to be sure, right? So make sure you're, as Emily said up top, cross those T's, dot those I's. This idea here, I think, just to hit on, because if you're going to do this right, folks will come to us and say, I want out, or I want to do a succession plan. And sometimes they're ready, sometimes they're too late, like we talked about earlier. But if they're thinking ahead, they may come to us and we may say, okay, you're on the right track, but what you really need is somebody like Emily. You need to bring somebody in to work on reducing that company specific risk, increasing those multiples. And so knowing who to involve in your team, and then somebody needs to be the quarterback. Somebody needs to be running this operation so that the lawyers in their silo and the CPAs here, and you might have an estate attorney and folks like that, but how is it all being coordinated? Because again, this succession planning thing, most people are only going to do once. So we want to make sure it's done right. And we want to make sure that it's coordinated so that you're getting the best outcomes. So before we open up for questions, just brief here, key actions, key takeaways. Leadership, have a pipeline, don't keep it all in your head. Right? Document, document, document. You've got to do it, even if you don't think it's important. It certainly is. And that creates this idea of, and Emily was hitting on it earlier, about this business continuity plan. What do we do if something happens to so and so? Who would make this decision? Who's signing the checks? How do we make payroll? Who can talk to the bank? Who's hiring and firing? Right? All these little things are gonna make a real big difference to your organization and your growth and the ease of transition. So with that, we're going to open it up for questions here. Thanks so much, everybody. Rick, fire away.
So if you do have questions for Emily or Sam, hit the Q&A button at the bottom of your screen and type your question there. We do have a couple of questions waiting. So first, What operational red flags do buyers typically identify during due diligence that owners may not realize are issues?
Emily, you want to go ahead? Or you want me to take that one?
Either way.
Okay, fire. You take this one first, and
Okay.
I'll
Things I see, comes down to the processes, and not having clearly defined roles and governance, who does what. Think of it, for me, a lot of owners, they're not actually trying to sell their business, they're trying to sell their job. Because again, if I'm the center of the universe and everything goes through me, then that's really what I'm trying to sell. And that's so when they see that, that's the first and largest red flag that I help people overcome.
Yeah, I think that's really important. And one thing I would add to it is just making sure that where you can, a lot of this is legally binding, right? Whether it's a stockholders agreement, whether it's a director's resolutions, something that has a little bit more teeth than, well, I wrote some notes and I put it in a filing cabinet. Is never never a great way to have to do this, because when folks are emotional, it's much easier if you have something to point to that everybody knows is there, that gives a more or less clear path. So once you've got these ideas down, let's put them into an actually legally binding document, because then we know that we've got some teeth if there is questions around what do we do or who can make that decision.
And also, the interesting thing I've noticed, we've been talking and focused a little bit conversationally around single location dealers, perhaps, or an owner that's very much at that. But interestingly enough, I also see it when I work with larger organizations, still family owned, but multiple locations, and they've got some management structure in there. It's interesting how there can be uh, micro environments within an organization. So some
Right.
of these challenges we're talking about, the company or the owner might think they've got it covered, but over the years they've lost control and there's chaos at different branches, and everybody kind of runs their branch as their world.
Yeah, the little fiefdoms. Yeah, exactly.
Yeah.
Exactly.
All right. What are some quick improvements owners can make in the next 12 to 24 months that could meaningfully increase business value?
Yeah, so that's a really good one. I'll start with one, which is clean up the financials. Take a look at your balance sheet, take a look at your income statement. There are likely accounts on there that you could either tighten up or get rid of completely, right? We're carrying a car on the books that really we're using we're using personally, or we're running certain expenses through our travel account that we need to separate out. I think that's a really important one to look at, right? We've had this shareholder loan on the books forever because when dad left, we just kind of paid it out as we could. Well, these are things to clean up and really think about, because somebody's going to start asking questions, and once they start asking questions, you can think of that as a tick off the multiple. Well, why are you doing this? Well, that's another tenth of a point off the multiple. So really, that would be one of my suggestions.
All right. Let's see. Here's a good one. Are either of you aware of an independent dealer marketplace for us independents that don't want to sell to a BFS, Kodiak, QXO, US LBM, etc.? Somewhere we could market ourselves to other independents.
Yeah, that's a really good question. So two places I would look. I know that the NHPA does have their own marketplace. It's typically more smaller hardware style, not the dealers, but it's something to consider. And another thing to consider with something like that is there may be listing fees. So do your due diligence, so to speak, before you go on there. But I would say that probably for dealers, the best place to start is your buying group. Whether you're LMC, whether you're LBM Advantage, go and talk to the folks there, because they're always fielding calls from other dealers who are looking to acquire or looking to sell. And so it may be that that's the best place to go and find a match because it's within the same buying group, and obviously there's an incentive, right? If you're an LMC member, there's an incentive for them to keep you there. But you sell to another LMC dealer, and that might be a little bit smoother, right? From an operational process, you're both buying from the same place. So that's really where I think dealers should really start, is with their buying group.
Right. If an owner isn't planning to transition for another 5 to 10 years, when should they start making operational improvements that could increase the value of their business?
Now, right, Emily?
Today, as soon as you get off this call, go just pick one thing. Pick one thing.
Yeah, and I think, Rick, too, it can get overwhelming, right? You look at the list and it's, oh my gosh, we've got to do all this stuff. Well, there's likely, and this is again using the professionals, talking to somebody like Emily, there's likely a hierarchy, and there are probably two or three things that will drive most of the value growth. And then the other things you can do all when you have time for them. So really do some thinking about that, because as Emily said, it's a lot easier for us to change one thing, right? If I want to, start exercising and eat better and sleep longer, and the list goes on, I'm going to end up doing none of those things. But if I decide that I'm going to go to bed a little earlier every night, and I really focus on that for 6 or 7 months, I'm probably going to be able to accomplish that. And it's the same thing when you're working on changes to your business.
And if you write that goal down,
There you
right?
go. Yes, exactly. Write
And
it down.
Write it
action
down.
point.
All right. We have one more question. Are there operational investments that improve profitability but don't necessarily increase valuation?
Not that I can think of. Because
I
if you're
think,
increasing profitability, you're probably going to increase value. So
yeah, just gonna have to suck it up and deal with the higher value of your company.
yeah, right. I know. Darn it, right?
Right. All right. Well, Sam and Emily, thank you so much for sharing all this information. Lots of really good information, especially on the operational side, which is where there's a lot of questions. So, and Sam, I mean, from personal experience, I know you do a great job with your valuation. So thank you both for your time. And
Yeah,
yeah, and thanks everybody
our
for
pleasure.
joining us. And we'll see you next time.
Yep.
Thanks,
Thanks,
everyone.
everybody. Thanks, Rick. We appreciate it.
Okay, goodbye.
Take
All right.
care.
Take care.